Hello, everyone, and welcome to How to Amicably Divorce the IRS and Retire Earlier, Happier, and Tax-Free. I'm your host, Dave Spence, and you can see my credentials there on the left. But over on the right, you can see also how my shirt blends in so nicely with the border. It's kind of cool. I didn't even try to do that. All right, this course is for you if you're always looking for something new and innovative. This is going to be some new thinking. It's also for those who don't trust the government to be making their financial decisions for them. It's for those who value their current advisors, but they're the trust but verify type. It's for those who have or expect to have $1 million or more in their retirement nest egg. Just to give you an idea from a financial standpoint, the more assets that you have, the more options that you have, and the more problems that you could run into. It's also for tax professionals who are considering doing more planning for their clients for the future. Here's what I'm going to cover in this course, just so you know in advance, and I hope that you'll stay with me all the way through. America's national debt is at its highest and most dangerous level ever, and that's inevitably going to lead to higher future taxes. Those can be avoided with some proper planning techniques today and over the next 7 to 10 years. And I'm going to explain why, for good reasons, your advisors may not be telling you this at all. Now, full disclosure, this is the better part of an online course that I offer for a fee. Although today's course is free, there is another one that's a little bit more detailed online for a fee, and it might be appropriate for some who want more details and want to take the next steps. So keep that in mind as you go through. U.S. Debt Clock. You can reach it by going to usdebtclock.org. And here we see the ongoing increase in our U.S. national debt. Our debt is now at $31.6 trillion as of this recording. And what that means is, let's see, most economists will tell you that the dollar amount itself is not as important as how it compares to our U.S. gross domestic product. Our GDP is now at $26 trillion and the debt is at 31. The ratio that economists would recommend is that the debt be 40 to 70% of the U.S. gross domestic product. So the debt ought to be 40 to 70% of this 26 trillion, or let's just say half. It should be $13 trillion and it's $31 trillion. So instead of being between 40 and 70, it's at 134% of debt or GDP. The debt to GDP ratio is 134%, which is terrible. It's never been this high in the history of our nation. The four biggest expenditures in our budget are Medicare and Medicaid, Social Security, defense, and the interest on the debt. Now, this interest on the debt, $547 billion, over $1/2 $1 trillion, is due on money that we borrowed last year and the year before. We spent it in previous years, and we have to pay interest on that, just like running up a credit card too high. Ideally, this would be zero. If you're debt-free, you pay nothing in interest, and we are paying $500 billion. So that number we could eliminate, but $500 billion doesn't do much to 31 trillion. Defense isn't going to go away. We can't really trim it very much as long as there are North Korea's around and Iran's around and Putin and Hitler's and so forth. So that's probably not going to change dramatically. So we have Social Security and Medicare, and we have revenues. U.S. federal tax revenue is $4 trillion, but our budget per year is $6 trillion. So we're planning, obviously, to add another $1.4 trillion to the national debt just by having our budget out of balance. Lastly, on this clock, I'd like for you to see down here unfunded U.S. liabilities, and the description is up in the box at the top. This is the federal debt. It's also unfunded liabilities for Social Security and Medicare, as well as federal employees and veterans benefits. So these are dollars that have to be spent to pay for retirees, collecting Social Security, federal pensions, veterans benefits, Medicare. All of that stuff is not in the national debt. So the real number is more like $182 trillion. So we've got a serious problem, and we're not doing enough about it.
Let's look at the history of our deficit here, dating back to before World War II. You can see in World War II, we ran up a tremendous amount of debt in winning that war, and our debt to GDP ratio got to about 120%. And then we reduced the debt balance over the next 40 years, mainly by raising tax rates. And you'll see in a moment the tax rates all the way from the mid-40s to the mid-80s were greater than the tax rates that we deal with today. Also, during that period of time, the baby boomers were born. From 1946 to 1964, the baby boom generation came, and now they're retiring and looking to collect Social Security and Medicare benefits and so forth. In 1986, we rewrote the tax code and brought tax rates way down from where they were in the early 80s, and for that whole 40-year stretch. And you can see our deficit continued to climb under Reagan, Bush 1, Bush 2, Clinton brought it down a little bit. Obama took it up, Trump took it up, Biden's taken it up. So we're now at 134% and climbing. Here's a look at the tax rates today. 2023 federal income tax rate table. 10% is paid on the first 11,000 for a single filer, 22,000 for a married couple. On the next dollars, you'd pay 12%, and you can see the ranges. And then it jumps from 12 to 22%, and then 2% more to 24. And then it takes another big jump, 8 percentage points to 32, and then 3 percentage points and 2 percentage points. So there's really a bit of a sweet spot here, if you will, where a married couple making $90,000 to $364,000 could pay taxes at 22% and 24%. And the question is, would that be better to pay those taxes today and convert some of our tax deferred assets to Roth and so forth, if tax rates are going to go up dramatically in the future? So that's part of the premise here. And we want to remember that sweet spot of 22 and 24%. Now, looking back, here's a calculator that I'm updating right now for newer tax rates, but from 2021, if somebody was making $150,000, they would be in that marginal tax bracket of 22%. This is for a married couple. And the effective tax rate would be 16, meaning that some of their money's taxed at 22, but also some of it's taxed at 10% and 12%, remember? So effectively, they would pay 16% or $24,500 on $150,000 of income. Now, if we adjust that $150,000 for inflation, you can see what they would be making in these prior years. And you could see their marginal tax bracket would be 38%, 39%, 28, 30, even 41% back in 1945. And you can see the effective tax rate, instead of being 16, would have been 25, 27, 21, and so forth, 30%. So they would have given 30% of their income to taxes back in 1945, and they're only given 16% here in 2021. Again, adjusting their tax bill into today's dollars, instead of paying 24,000, they would have paid 37, 39, 31, 36, and 44. So our tax rates today are dramatically less than they were during that period of time when we brought down the national debt. So that's what we did from 45 to 85, and now it's gone haywire on us again. And you can see that the ratio is 134% when it should be more like 40 to 70%. There's basically just three ways that we can reduce the debt balance: raise revenues, reduce spending, or some combination. Now, as far as spending goes, imagine if Congress voted to reduce Social Security benefits or to reduce Medicare. Do you think the baby boomers would have any problem with that? What if Congress just printed more money, which they have done, to the point where inflation starts heating up? Whoops, it already has. And what if the Fed had to raise interest rates to fight inflation? Guess what? It already has. What if you were a member of Congress and had to face this dilemma? Oh, and you wanted to be reelected. What would you do? Exactly what Congress is doing, perhaps. Keep kicking the can down the road. So, how can we get rid of this? How can we divorce the IRS and retire happy and tax-free? Consider right now we are partners with the federal government, and they get to decide how much of our income they get to keep, even of our assets. We just get what's left over as long as we're subject to their rules. There are basically 5 steps that we can take on to divorce the IRS and move as much money as we can into tax-free cash flow sources for retirement. We're going to go through each one of these one by one. But the first is to sort assets into 3 categories: taxable, tax-deferred, and tax-advantaged. Then we want to determine your marginal tax bracket and figure out the ideal amount available to you to divorce the IRS. We're going to do that by taking your current income and subtracting it from the top of the 24% tax bracket. So we want to use all of the 22 and 24% tax bracket. Some may consider using 32% as well if they really feel like tax rates could double in the future. But we want to determine the availability of the funds, what you have access to, and how you could tap it, including the cost of tapping it, and set a budget for how we would approach moving money into that tax advantage bucket. We would list all available Roth options, and you may be surprised to know how many that you might have access to. And we want to create at least 4 tax-free income streams gradually over the next 7 to 10 years. I talk about 7 of them in my online course, Secret Tax Saving Ideas Your Advisors Aren't Talking About. So step 1, sort assets into 3 categories. The first one is taxable assets that are taxed as they grow. They send you a 1099 every year. So you would have a checking account, savings accounts, brokerage accounts that send you 1099s. These are numbers from an actual case, and I do the case study in the course online. But these clients, the married couple, had $256,000 in taxable accounts. They had $1 million in tax deferred assets. These are pre-tax accounts that they've saved up: thrift savings plans, IRAs, 401ks, 457 plans, and it shows how much they were contributing and how much was being matched by their employers. The best account, the tax advantaged accounts, are Roth accounts, health savings accounts. They had one, but they weren't really saving up in it. They were just spending it currently. And there was some cash value life insurance, which is another asset that you can tap tax-free in retirement. Now I would take this and add some relevant notes down here, like their ages, their household income, taxable income, spending needs annually, tax bracket, and the room to the top, to the, the first dollar being taxed at 32%. So in this case, there's $190,000 that they could add to their taxable income and move money over to the tax advantaged accounts. Whether they're covered by Social Securities and pensions, home equity, net worth, and so forth. I've had a lot of requests for this spreadsheet, so we do offer it for $19.99 at taxfreetutors.com if you'd like to purchase one and work on your own. Step 2 would be determine your own marginal tax bracket. This is a tax return, page 1 from 2022. And it shows here the bottom half of this thing. I'll show you moving it in. The last line on this form is your taxable income. So if you take this number, in this case with this couple, it was $174,000, and you go back to the tax bracket, you see they're in that sweet spot there between 22 and 24. They're actually not even to the top of the 22% bracket yet. That's why they have $190,000 that they could do before they get to $364,000. So steps 3B would be to determine the funds available for the divorce. Now, what I'm saying here is that in the first bucket, the taxable accounts, you really shouldn't be getting 1099s and having to pay taxes every year on your safe money. And this should be safe money that you could tap. It should be about 6 months worth of your spending needs. In this case, they spend $100,000 a year, so we really don't need more than about $50,000 there. Some people may not feel comfortable with 50. They might want 100,000. I don't care. That's fine. But we should set a target in there and know what's available other than the ideal amount, and move forward to use some of that money to fund this tax advantage account. Also, because they're in a 22% tax bracket, they've got $190,000 that they could add to their current income and not have to pay more than 22 or 24%. With this $1,050,000 in here, what's the ideal balance in the retirement account? You want to get that down to where you don't have to take large required minimum distributions later in life, because that's going to complicate matters. Even when you don't need those RMDs, they get taxed, and they might be taxed at a much higher tax bracket than today. So they could, at least in theory, move $190,000 a year from this bucket to this bucket by way of Roth conversions and not have to pay more than 24% federal tax. Next, identify all potential Roth options. And here are 5 that you could think of. You can make Roth IRA contributions if your income is under a certain limit. And you can make contributions for a spouse even who doesn't have income, as long as your income is enough to match the minimum income needed to contribute to a Roth. So you can do like $6,000 or $7,000 a year, depending on your age, into a Roth IRA. If your income is too high, you're not allowed to contribute to a Roth. But then you can do a backdoor Roth. That's where you contribute to an IRA and then you convert it to Roth. There's no income limitation for contributing to a regular IRA. You may or may not be able to deduct it based on your income level, but we're not worried about that because we're going to convert it to Roth anyway. So even if you can deduct it, you convert it and you pay taxes on the conversion, so it's a wash. But if you don't deduct it and convert it, there's never any income to worry about. Roth conversions are when you take existing accounts and you convert them to Roth. Those have no income rules. You don't even have to have income to do that. And if you have too much income, you can still do that. Roth 401k, 403b, etc. Many retirement plans, 70% of them, it's estimated, offer Roth options. So your salary can go into the plan as pre-tax, which is what people have traditionally done mostly, or it can go in as Roth. And now even the employer contributions or matches or profit sharing contributions can go in as Roth as well. And then there's the mega backdoor Roth, which is a topic for another day because it's a little bit complicated. More potential tax-free income sources are discussed in the online course for a fee, but they include health savings accounts, reverse mortgages, and cash value life insurance. So we get to step 5. How are we going to create multiple tax-free income streams? We want to strategically move $1 million from tax advantage bucket or to the tax advantage bucket over 7 to 10 years, paying taxes with the taxable account funds until after age 59 and a half. If you converted money here over to the tax advantaged Roth conversions, for example, and you paid the taxes with the money itself, you had it withheld from the conversion, and it was before age 59 and a half, there would be a 10% penalty. So it would be best to pay the taxes on the conversions out of here and convert every dollar into Roth, every dollar possible. We would also recommend not contributing on a pre-tax basis as much as they're contributing here, just do enough to get the company match. And then the rest is available for cash flow needs for taxes or conversions. And we would consider adding life insurance as a retirement plan. In this case, we did the number crunching and came out with 3 options. If we did nothing at all and the tax rates doubled, this client would run out of money actually by around age 90, 92. They would still get a little bit of income from Social Security and pensions, but basically their assets would be depleted. Strategy 2 says they do nothing at all and tax rates stay where they are. Because their assets would grow and grow, and then required minimum distributions would be required, they would have to pay taxes on those distributions. Effectively, they would run out of money at about age 105 or so, 103 maybe, but they would have $600,000 instead of $2 million by the time they reached age 100. So they probably would be all right. Strategy 3 says that they'd follow all the recommendations and tax rates do double. They end up with $4 million of net worth and they never run out of money at all. Now, you might be wondering at this point, this all sounds a little bit too good to be true, and you must be missing something because you've never heard of this before. You always assumed that you'd be in a lower tax bracket. Your advisors should have all this covered. Let's talk about 4 myths. The first is that you'll be in a lower tax bracket in retirement. This is an oldie but goodie. Our debt is over 130% of GDP, and the target is 40 to 70%. Social Security and Medicare are something that the baby boomers are going to refuse to give back. Printing too much money, which is what we've been doing, puts more money in the marketplace for the same goods and services, which means it drives prices up. Inflation, and then inflation causes higher interest rates. And that makes it more expensive to borrow. All this debt that's out there has to be refinanced, and it's going to cost more when we refinance it because interest rates will be higher. We've been here before, and there's no answer that completely avoids higher taxes. Myth number 2, I'll lose all the earnings on those tax payments if I pay them early. That's a false statement, and here's where the game is really won. Let's take $100,000, Let's take $100,000 that you're considering converting to Roth today. If we pay a 24% tax on that conversion, let's assume this $100,000 is going to double, okay, by the time you spend it. So that $100,000 is eventually going to be worth $200,000. So let's look at that. if we convert the 100,000 today and pay a 24% tax, then we have $76,000 left over. If that doubles by the time we need to spend it, it's $152,000. Now, if we don't convert it today, that 100,000 grows to 200,000. And if tax rates were to double, we pay a 48% tax instead of 24%, and we have 104,000 instead of 152,000. And tax rates don't have to double in order for this to make any sense. If we just have rates go up by 1%, we take the $100,000 to $200,000, we pay a 25% tax, you're left with 150,000 instead of 152. So just with a 1% tax rate difference, it makes sense to do the conversion today and then let the money double. Plus, I've made some notes here. Higher retirement income means higher Medicare premiums, and tax rates basically double when one spouse dies. Think about that. If you're a married couple, look at your income here. 10% is taxed up to 10% tax up to 22,000. A single person pays 10% on 11,000, then jumps to 12%. Down here, if that $174,000 that this couple is earning is coming mostly from savings, then it's going to continue to come. And instead of being in this tax bracket, 22% at 174,000, the survivor would be near the top of the 24% bracket. So your tax rate's basically going to go up when one spouse dies. Myth number 3, my tax preparer already handles all this for me. Actually, probably not. Your tax preparer is swamped at tax time, and priorities are meeting deadlines and getting your bill as low as possible. They normally don't talk about Roth conversions because that would raise your tax bill. In fact, they don't even know what you've accumulated in IRAs and employer plans unless you're over 70 and they have to deal with required minimum distribution rules. So if you're in your 30s, 40s, 50s, even 60s and haven't started taking money out of savings, they don't even know how much is there. Those accounts don't generate 1099s, and that's what they deal with at tax time. Myth number 4, if it's important, my investment advisor will tell me what to do. Actually, that's probably not true either. Most investment advisors don't know enough about taxes to warn you. Surely that's what your tax preparer does, right? They're assuming your tax pro is doing it. Plus, Roth conversions would only mean that you have to pay tax on assets today rather than later. So you're going to be taking money away from them that they want to manage instead. Lastly, they don't know anything about life insurance, and life insurance can sometimes be a great tax shelter. All the rich use life insurance as a tax sheltered savings account, and now more Americans than ever can do it, but you have to be very careful. So our takeaways are that we've been here before. There are practical tools that you can use to divorce the IRS, and you should be taking action now. What kind of action steps can you take now? First is you might want to order the 3-bucket pro forma sheet for $19.99 from our website and envision your own action plan in numbers and words. You may want to take the online course. We'll offer you a 20% discount by taking this course first. Secret tax saving ideas your advisors aren't showing you. Listen to some of the leading voices on our national debt and the potential for higher future tax rates. People like Ed Slott, America's IRA expert, and leading fundraiser and presenter on public broadcasting system. The Honorable David M. Walker, the former U.S. Comptroller General under Obama and President George W. Bush. Maya McGinnis, the chairwoman of the Committee for a Responsible Federal Budget. David McKnight, the author of The Power of Zero and other bestsellers on reaching a 0% tax bracket. Maybe ask your tax professional to consider taking this course and provide you some thoughts. And reach out to me to help you find a tax-free tutor, someone who's up to speed on all of this and working toward helping people eliminate taxes in retirement. I have a network of tax-free tutors around the country, and I'd be happy to introduce you to one. Again, the online course is Secret Tax Saving Ideas Your Advisors Aren't Showing You. It's at udemy.com. And the course to get you there, the track to get you there, the link is udemy.com/tax-free degree. And you can use divorce IRS 20 as a code to get 20% off. That's for a limited time. I think it's about 20 to 30 days you might have to be able to use this coupon. We have a time for a couple of questions maybe. And I'll leave the link up here for the online course.